Question 1. Which of the following is a key benefit of utilizing a captive insurance company instead of purchasing traditional insurance from a commercial insurer? A. The ability to transfer risk to a third-party insurer. B. The ability to customize coverage based on the unique needs of the parent company. C. The guarantee of no premium volatility. D. The requirement to submit claims only to the state insurance commissioner. Answer: B. The ability to customize coverage based on the unique needs of the parent company. Explanation: a significant advantage of forming a captive insurance company is the ability to tailor the insurance coverage specifically to the needs of the parent organization, rather than relying on the one-size-fits-all approach typically seen with traditional insurance providers. By establishing a captive, the parent company can address risks that may not be covered by standard insurance policies, thus customizing coverage in a way that meets its particular risk profile. Option A is incorrect because a captive insurance company does not transfer risk to a third-party insurer. Instead, the risk is retained by the captive. Option C is incorrect because premium volatility can still occur in captives based on the claims experience and the underlying risk. Option D is incorrect because claims in a captive insurance company are handled internally or within the captive structure, not through the state insurance commissioner. Question 2, scenario-based. Mr. Harris, the CFO of a medium-sized manufacturing company, is tasked with deciding whether to form a captive insurance company. He has a risk appetite that is focused on retaining a portion of the company's risk but still wants to mitigate catastrophic losses. Mr. Harris is considering setting up a single-parent captive insurance company to cover various risks such as property damage, product liability, and workers' compensation. Which of the following steps should Mr. Harris take first in the process of establishing a captive insurance company in Idaho? A. Submit a business plan to the Idaho Department of Insurance (DOI). B. Arrange for an independent audit of the company's financials. C. Decide on the capitalization amount for the captive based on Idaho's regulatory requirements. D. Choose a third-party insurance carrier for reinsurance. Answer A. Submit a business plan to the Idaho Department of Insurance (DOI). Explanation: in Idaho, as per Title 41 of the Idaho Code, the first formal step in establishing a captive insurance company is to submit a business plan to the Idaho Department of Insurance. This business plan should outline the risks the captive will insure, its financial projections, capitalization, and the operational structure. The submission of the business plan is a required part of the licensing process before the company can proceed with formation and obtain approval. Option B is incorrect because an audit is important later in the process, but the initial step is submitting the business plan to ensure the captive meets regulatory requirements. Option C is premature at this stage. While capitalization is critical, it is part of the overall plan that must be submitted as part of the business plan. Option D is irrelevant at this initial stage as reinsurance decisions are made later once the captive is in operation. Question 3. Which of the following is a regulatory requirement for captive insurance companies in Idaho regarding financial solvency? A. Captives must have a minimum surplus of $2 million. B. Captives must undergo an independent audit by a licensed actuary every 3 years. C. Captives must maintain solvency margins that are in line with Idaho's risk-based capital requirements. D. Captives are not required to submit financial statements to the Idaho Department of Insurance if they meet the minimum capital requirement. Answer: C. Captives must maintain solvency margins that are in line with Idaho's risk-based capital requirements. Explanation: under Idaho law, captive insurance companies are required to maintain solvency margins that align with the state's risk-based capital (RBC) requirements. These requirements ensure that captives maintain adequate financial stability to cover their obligations and mitigate the risk of insolvency. The Idaho Department of Insurance sets guidelines that captives must adhere to in terms of capital adequacy, and these solvency margins are a critical part of maintaining regulatory compliance. Option A is incorrect because the minimum surplus requirement for captives in Idaho can vary depending on the type of captive and the risks it insures and is not uniformly $2 million. Option B is incorrect because Idaho law does not mandate an independent audit by an actuary every 3 years. While audits are required, they are typically annual, not every 3 years. Option D is incorrect because captives are required to submit annual financial statements to the Idaho Department of Insurance to ensure transparency and regulatory compliance. Question 4. Which of the following is a key factor in determining the financial viability of a captive insurance company in Idaho? A. The geographical location of the parent company. B. The company's claims history and projected risk profile. C. The number of employees in the parent company. D. The company's overall profitability in non-insurance operations. Answer B. The company's claims history and projected risk profile. Explanation: the financial viability of a captive insurance company is primarily determined by its ability to handle the risks it insures, which involves evaluating the company's claims history and its projected risk profile. Captives must ensure that their financial resources, including capital and surplus, are sufficient to cover anticipated claims based on the risks they retain. Option is incorrect because the geographical location of the parent company does not directly impact the financial viability of the captive insurance company. Option C is incorrect as the number of employees does not affect the financial viability of a captive, although it may influence the risks being covered. Option D is incorrect because the profitability of non-insurance operations is irrelevant to the financial viability of the captive, which depends on its own capital and solvency. Question 5. When forming a captive insurance company in Idaho, what is the minimum capital requirement for a single parent captive that will be writing property and casualty insurance? A. $500,000. B. $1 million. C. $2 million. D. $3 million. Answer B. $1 million. Explanation: in Idaho, the minimum capital requirement for a single parent captive writing property and casualty insurance is $1 million. This capital requirement is in place to ensure that the captive has sufficient financial resources to cover its insurance obligations and maintain solvency. Idaho's Department of Insurance provides specific guidelines that captives must adhere to in order to protect policyholders and ensure financial stability. Option is incorrect because the minimum required capital for property and casualty captives is higher than $500,000. Option C and Option D are incorrect as they exceed the regulatory requirement for capital. Question 6. Scenario-based. Mr. Adams is the CEO of a construction company that is considering establishing a group captive insurance company with several other similarly sized companies in the industry. He is unsure about the process of choosing an insurance manager for the captive. What should Mr. Adams ensure when selecting the manager for the group captive? A. The manager should have at least 5 years of experience managing captives in other states but does not need to be licensed in Idaho. B. The manager must be approved by the Idaho Department of Insurance and have expertise in group captives. C. The manager should be an independent contractor with no prior involvement in the insurance industry. D. The manager should be chosen based solely on cost to ensure the lowest management fees. Answer B. The manager must be approved by the Idaho Department of Insurance and have expertise in group captives. Explanation: the Idaho Department of Insurance (DOI) requires that captive insurance managers be approved by the department. This is particularly important for group captives where the manager must have specialized expertise in managing captives, including compliance with Idaho's regulatory and financial requirements. It is essential that the manager has the necessary experience and qualifications to operate within Idaho's legal framework for captives. Option is incorrect because while prior experience is important, the manager must be licensed in Idaho, not just have experience in other states. Option C is incorrect because an independent contractor with no insurance industry experience may not meet the qualifications required to properly manage a group captive. Option D is incorrect because choosing a manager based solely on cost can lead to inadequate management and potential regulatory or financial issues for the captive. Question 7. Which of the following best describes the role of the board of directors in the governance of a captive insurance company in Idaho? A. To set insurance premiums and determine coverage limits for all policies issued. B. To ensure that the captive operates in compliance with Idaho's regulatory requirements and industry standards. C. To manage day-to-day operations and settle claims directly with policyholders. D. To handle reinsurance arrangements and purchase insurance from third-party insurers. Answer B. To ensure that the captive operates in compliance with Idaho's regulatory requirements and industry standards. Explanation: the board of directors of a captive insurance company has a fiduciary duty to ensure that the company operates in compliance with applicable laws, regulations, and industry standards. This includes overseeing financial solvency, ensuring that operational practices adhere to Idaho's regulatory framework, and safeguarding the interests of the parent company. Option is incorrect because setting premiums and determining coverage limits is part of the underwriting and operational management, not the direct responsibility of the board of directors. Option C is incorrect because managing day-to-day operations and settling claims is typically the responsibility of captive management, not the board. Option D is incorrect because the board's role is to ensure proper governance, not necessarily to manage reinsurance or purchase insurance from third-party insurers. Question 8. What is a potential drawback of forming a captive insurance company for a small business? A. Increased regulatory oversight and administrative costs. B. Limited ability to customize coverage for specific risks. C. Immediate tax benefits and deductions for all premiums paid. D. Limited access to alternative risk financing mechanisms. Answer: A. Increased regulatory oversight and administrative costs. Explanation: One potential drawback of forming a captive insurance company is the increased regulatory oversight and administrative costs. Captives must comply with both state and federal insurance regulations, which can require significant resources for legal and accounting purposes. Additionally, captives must meet solvency and capitalization requirements, which could involve ongoing operational costs. Option B is incorrect because captives offer a high level of customization in coverage, which is one of the primary benefits of forming one. Option C is incorrect because tax benefits for captives are subject to specific requirements and are not immediate or guaranteed. Option D is incorrect as captives actually provide enhanced access to alternative risk financing mechanisms rather than limiting it. Question 9. Which of the following must be included in the business plan submitted to the Idaho Department of Insurance when forming a captive insurance company? A. A detailed description of the business model and the risks to be insured. B. A list of all officers and directors, including their compensation packages. C. An assessment of the market share of similar insurers in Idaho. D. A complete audit report from an external auditor. Answer: A detailed description of the business model and the risks to be insured. Explanation: The business plan submitted to the Idaho Department of Insurance must include a comprehensive description of the proposed business model for the captive as well as the specific risks it plans to insure. The Idaho DOI uses this plan to evaluate whether the captive is financially viable and whether it meets state regulatory standards. The business plan is a crucial part of the licensing process. Option B is incorrect because while a list of officers and directors is required, compensation details are not typically included in the business plan for regulatory purposes. Option C is incorrect because market share assessments are not a required part of the business plan for forming a captive in Idaho. Option D is incorrect as a full audit report is not required to be included with the initial business plan submission. Audits are performed later as part of ongoing compliance. Question 10. Which of the following factors is most critical in determining the appropriate minimum capitalization for a captive insurance company in Idaho? A. The amount of risk retained by the captive. B. The total number of shareholders in the parent company. C. The number of states in which the captive will operate. D. The parent company's market share in the industry. Answer: A. The amount of risk retained by the captive. Explanation: The amount of risk retained by a captive insurance company directly impacts the required capitalization. The more risk a captive is expected to retain, the higher the minimum capitalization required to ensure it can meet its liabilities and maintain solvency. Idaho's regulatory framework mandates that captives demonstrate sufficient financial capacity based on the level of risk they assume. Option B is incorrect because the number of shareholders does not directly affect the minimum capitalization requirements. Option C is incorrect since the number of states in which the captive operates doesn't influence capitalization in Idaho. Option D is incorrect because the market share of the parent company is unrelated to the capitalization requirement for the captive. Question 11. A captive insurance company in Idaho must submit an annual report to the Idaho Department of Insurance. Which of the following is not typically required in the report? A. Audited financial statements. B. A list of claims paid during the year. C. The solvency margin and capital adequacy. D. A description of the operational performance of the captive's parent company. Answer: D. A description of the operational performance of the captive's parent company. Explanation: The annual report required by the Idaho Department of Insurance focuses on the financial and operational aspects of the captive insurance company itself, not the operational performance of the parent company. The key items in the report include audited financial statements, claims paid, and solvency and capital adequacy. Option is incorrect because audited financial statements are required as part of the annual reporting to ensure the financial health of the captive. Option B is incorrect because a list of claims paid is important to assess the captive's claims experience and financial stability. Option C is incorrect as solvency margins and capital adequacy are critical to ensure the captive remains financially sound. Question 12. Scenario-based. Mrs. Thompson owns a manufacturing business and has recently formed a captive insurance company to cover product liability claims. She is concerned about the exposure of the captive to large claims. What would be the most prudent step for Mrs. Thompson to take to manage this risk exposure? A. Increase the capitalization of the captive to cover larger claims. B. Purchase reinsurance to cover catastrophic losses. C. Decrease the premium rates to attract more policyholders. D. Eliminate coverage for high-risk claims in the captive's policies. Answer: B. Purchase reinsurance to cover catastrophic losses. Explanation: to manage the exposure to large or catastrophic claims, the most prudent action for Mrs. Thompson would be to purchase reinsurance. Reinsurance allows the captive to transfer a portion of the risk to another insurer, which helps mitigate the financial impact of large claims. This strategy is common in captives to ensure solvency in the event of unpredictable losses. Option is incorrect because while increasing capitalization can help with financial stability, it does not directly address the exposure to large claims in the same way reinsurance does. Option C is incorrect because lowering premium rates could increase the risk of undercapitalization and could result in the captive not having enough funds to cover claims. Option D is incorrect because eliminating coverage for high-risk claims may result in inadequate protection for policyholders and may violate regulatory standards. Question 13. What is the primary role of the Idaho Department of Insurance (DOI) in relation to captive insurance companies? A. To directly manage the claims process for captives. B. To monitor compliance with regulatory requirements and ensure financial solvency. C. To approve insurance policies issued by captives. D. To provide tax benefits and exemptions to captives. Answer: B. To monitor compliance with regulatory requirements and ensure financial solvency. Explanation: the Idaho Department of Insurance (DOI) is responsible for regulating captive insurance companies within the state. This includes monitoring their compliance with Idaho's insurance laws, ensuring that captives meet financial solvency standards, and overseeing that they adhere to the regulatory guidelines set forth by the DOI. Option is incorrect because the DOI does not manage the claims process for captives, and that responsibility falls to the captive itself. Option C is incorrect because the DOI does not approve individual insurance policies, but it ensures captives are operating within regulatory frameworks. Option D is incorrect because the DOI does not directly provide tax benefits, however, captives may benefit from certain tax treatments under federal law. Question 14. Which of the following is an essential requirement for a captive insurance company in Idaho regarding solvency? A. The captive must have an independent board of directors with a majority of non-executive members. B. The captive must maintain sufficient surplus to meet its liabilities and avoid insolvency. C. The captive must offer reinsurance to cover a portion of its underwriting risk. D. The captive must provide annual statements to the Idaho DOI detailing operational strategies. Answer: B. The captive must maintain sufficient surplus to meet its liabilities and avoid insolvency. Explanation: solvency is one of the most important regulatory concerns for captive insurance companies in Idaho. Captives must maintain adequate surplus to ensure they can meet their liabilities and remain solvent. This requirement ensures that captives can absorb any potential losses and continue operating without jeopardizing the financial security of policyholders. Option is incorrect because while the board of directors plays a key role in governance, this is not the primary requirement regarding solvency. Option C is incorrect because while reinsurance may be a strategy for risk management, it is not an essential solvency requirement for all captives. Option D is incorrect because while captives must provide annual reports, detailed operational strategies are not typically a solvency requirement. Question 15. Under the Idaho captive insurance law, which of the following is true regarding the governance of a captive insurance company? A. The captive must appoint a third-party external auditor every year. B. The board of directors must be composed entirely of employees from the parent company. C. Captives are required to have at least one independent director to ensure proper oversight. D. Captives may not outsource any management or operational duties to third-party firms. Answer: C. Captives are required to have at least one independent director to ensure proper oversight. Explanation: Idaho law requires that captive insurance companies have at least one independent director on their board to provide objective oversight and to ensure compliance with the regulatory framework. This is to avoid conflicts of interest and maintain the integrity of the captive's governance. Option is incorrect because while captives must undergo audits, the appointment of an external auditor is not mandatory every year under Idaho law, although it is strongly recommended. Option B is incorrect because while employees of the parent company may serve on the board must include independent directors. Option D is incorrect because captives are allowed to outsource certain management and operational duties, such as to third-party managers under appropriate guidelines. Question 16. What is the primary benefit of forming a rent-a-captive insurance company in Idaho? A. It allows companies to share the cost of insurance while retaining control over their coverage. B. It offers immediate federal tax exemptions for all premiums. C. It allows businesses to avoid the requirements of insurance licensing. D. It guarantees low premium rates compared to traditional insurance policies. Answer A. It allows companies to share the cost of insurance while retaining control over their coverage. Explanation. A rent-a-captive allows companies to pool their resources to form a shared captive insurance company. This arrangement enables them to share the cost of insurance while retaining control over their own insurance coverage. It is an attractive option for smaller companies that may not have the capital to form their own standalone captive but still want the benefits of self-insurance. Option B is incorrect because rent-a-captives do not automatically provide federal tax exemptions. The tax treatment depends on the specific structure of the captive. Option C is incorrect because rent-a-captives still require proper insurance licensing and compliance with state regulations. Option D is incorrect because while captives may provide cost savings, they do not guarantee low premiums compared to traditional insurance, as rates depend on individual circumstances and risks. Question 17. Which of the following is true regarding the financial reporting requirements for captive insurance companies in Idaho? A. Captives must file quarterly financial statements with the Idaho Department of Insurance. B. Captives must submit an annual financial statement prepared according to generally accepted accounting principles, GAAP. C. Captives are required to submit monthly reports detailing claims activity. D. Captives must file only an initial financial report upon formation with no ongoing reporting requirements. Answer B. Captives must submit an annual financial statement prepared according to generally accepted accounting principles, GAAP. Explanation. Idaho requires captive insurance companies to submit an annual financial statement prepared in accordance with generally accepted accounting principles, GAAP. This provides transparency and allows regulators to assess the financial health and solvency of the captive. Question 18. Which of the following must be included in the application for forming a captive insurance company in Idaho? A. A detailed business plan and pro forma financial statements. B. A letter from the parent company's board of directors supporting the application. C. A list of all third-party service providers that will be involved in managing the captive. D. Evidence of the parent company's existing insurance coverage. Answer A. A detailed business plan and pro forma financial statements. Explanation. When applying to form a captive insurance company in Idaho, the applicant must provide a comprehensive business plan along with pro forma financial statements. This allows the Idaho Department of Insurance to evaluate the viability of the proposed captive and ensure that it has the financial resources necessary to operate effectively. Option B is incorrect because a letter from the board of directors is not a specific requirement for the application. Option C is incorrect because while the list of service providers may be requested, it is not a fundamental requirement for the application. Option D is incorrect because proof of existing insurance coverage is not part of the application process for forming a captive in Idaho. Question 19. What is the purpose of a captive insurance company's reserve fund in Idaho? A. To cover the operational costs of the captive insurance company. B. To pay dividends to the shareholders of the captive. C. To ensure the captive has adequate funds to pay future claims. D. To invest in securities on behalf of the parent company. Answer C. To ensure the captive has adequate funds to pay future claims. Explanation. A reserve fund is established by a captive insurance company to ensure that it has sufficient funds to pay future claims. The reserve fund helps protect the captive from liquidity problems and ensures that it can meet its obligations to policyholders. Option is incorrect because the reserve fund is not intended for operational costs but rather for claims-related liabilities. Option B is incorrect because dividends are not typically paid from the reserve fund. Option D is incorrect because investments are separate from the reserve fund, though the reserve may be invested to generate returns. Question 20. Which of the following best describes a protected cell captive insurance company in Idaho? A. The captive that only insures risks of the parent company. B. A captive where each policyholder's risk is segregated in individual cells. C. A captive that operates exclusively in Idaho. D. A captive that only offers reinsurance coverage to other captives. Answer. B. A captive where each policyholder's risk is segregated in individual cells. Explanation. A protected cell captive is a type of captive insurance company where the risks and assets of each policyholder are separated into individual cells. This provides a way to ring-fence assets and liabilities, ensuring that each cell's risks do not affect the others. This structure is often used when multiple businesses want to pool resources but still retain separate liability. Option is incorrect because a protected cell captive may insure the risks of multiple unrelated policyholders. Option C is incorrect as a protected cell captive may operate outside of Idaho depending on its regulatory approval. Option D is incorrect because protected cell captives may write primary insurance as well, not just reinsurance. Question 21. Under Idaho law, how often must captive insurance companies submit a financial audit report to the Department of Insurance? A. Annually. B. Biannually. C. Quarterly. D. Every 5 years. Answer A. Annually. Explanation. Captive insurance companies in Idaho are required to submit an audited financial statement to the Idaho Department of Insurance on an annual basis. This ensures that the captive is maintaining adequate financial health and solvency to meet its obligations. Option B is incorrect because the law requires an annual audit report, not biannual. Option C is incorrect as the requirement is for an annual report, not quarterly. Option D is incorrect because audits must be submitted annually, not every 5 years. Question 22, scenario-based. A captive insurance company in Idaho has incurred significant underwriting losses in its first 2 years of operation. The company has also received complaints regarding delays in claims payments. The Idaho Department of Insurance is conducting an investigation. Which of the following actions is most likely to be required by the Department of Insurance if the captive is found to be undercapitalized? A. The department will likely revoke the captive's operating license immediately. B. The department will require the captive to submit a plan to address its capitalization shortfall and improve operations. C. The department will issue a fine and impose restrictions on new business. D. The department will allow the captive to continue operating without any changes as long as it pays claims in a timely manner. Answer. B. The department will require the captive to submit a plan to address its capitalization shortfall and improve operations. Explanation. If a captive insurance company is found to be undercapitalized or has operational issues, the Idaho Department of Insurance will likely require the company to submit a plan to address the shortfall and improve its operations. The plan might include measures to increase capital, reduce expenses, or improve claims handling processes. Option A is incorrect because the Department of Insurance would typically give the company a chance to address its issues before revoking its license. Option C is incorrect because the primary action would be to address the capitalization issue, not to impose fines or restrictions unless the issue persists. Option D is incorrect because the department will not allow the company to continue without addressing solvency and operational concerns. Question 23. What is a key characteristic of a single-parent captive insurance company in Idaho? A. It insures the risks of multiple unrelated parent companies. B. It is owned and operated by a single parent company to insure its own risks. C. It only provides reinsurance to other captives. D. It operates under a mutual insurance structure. Answer. B. It is owned and operated by a single parent company to insure its own risks. Explanation. A single parent captive is a type of captive insurance company that is owned and operated by one parent company. This type of captive is designed to insure the risks of the parent company itself, rather than covering risks for multiple unrelated entities. Option is incorrect because this describes a group captive, not a single parent captive. Option C is incorrect because a single parent captive typically insures the risks of its own parent company, not other captives. Option D is incorrect because a mutual insurance structure is not a characteristic of a single parent captive. Question 24. Which of the following is an advantage of forming a captive insurance company in Idaho? A. Immediate exemption from state and federal tax liabilities. B. The ability to write insurance policies for third-party entities. C. Greater flexibility in customizing insurance coverage to meet specific needs. D. Guaranteed approval for coverage for all types of risks. Answer. C. Greater flexibility in customizing insurance coverage to meet specific needs. Explanation. One of the main advantages of forming a captive insurance company is the flexibility it offers in customizing insurance coverage. A captive allows the parent company to tailor the coverage to its specific needs, whether those needs are unique to the business or to certain types of risk. Option A is incorrect because tax exemptions are not automatic for captives and they may still be subject to certain state and federal taxes. Option B is incorrect because captives generally insure the risks of the parent company, not third-party entities. Option D is incorrect because the approval of coverage depends on regulatory standards and the captive's ability to meet them. Question 25. Which of the following actions could result in the Idaho Department of Insurance taking regulatory action against the captive insurance company? A. Failure to submit the annual financial report on time. B. Increasing the capitalization without notifying the department. C. Providing lower than market insurance premiums to unrelated entities. D. Paying dividends to shareholders based on unrealized profits. Answer A. Failure to submit the annual financial report on time. Explanation: the Idaho Department of Insurance requires captive insurance companies to submit their annual financial reports on time. Failure to do so could lead to regulatory action, including fines or other penalties. Timely financial reporting is essential for maintaining solvency and transparency. Option B is incorrect because while notification may be required, it is not an immediate cause for regulatory action. Option C is incorrect as offering lower than market premiums is not necessarily a violation unless it undermines the captive's solvency. Option D is incorrect because paying dividends based on unrealized profits could raise concerns, but it is not automatically grounds for regulatory action unless it affects solvency. Question 26. How does the Idaho Department of Insurance ensure that a captive insurance company remains solvent? A. By reviewing the captive's underwriting profits every quarter. B. By requiring captives to maintain a specific minimum level of surplus and reserves. C. By approving all policies and claims before they are issued or paid. D. By restricting the types of risks a captive may insure. Answer B. By requiring captives to maintain a specific minimum level of surplus and reserves. Explanation: the Idaho Department of Insurance ensures that captives remain solvent by requiring them to maintain a certain level of surplus and reserves. This requirement helps ensure that captives have enough financial resources to meet their future obligations and remain solvent in the event of claims or other financial challenges. The surplus and reserves provide a buffer to ensure the captive can handle unforeseen losses without becoming insolvent. Option is incorrect because the Idaho Department of Insurance does not typically review underwriting profits every quarter as a method for ensuring solvency. The focus is more on financial health through reserves and surplus. Option C is incorrect because the department does not approve individual policies or claims before they are issued or paid. The department focuses on overall regulatory compliance and financial stability rather than managing specific transactions. Option D is incorrect because while the department may regulate the types of risks that a captive insures to some extent, the solvency requirements are the primary method of ensuring financial stability, not limiting the types of insurance coverage. Question 27. Which of the following is a characteristic of a group captive insurance company in Idaho? A. It is owned by a single company and insures only the company's risks. B. It is formed by multiple unrelated businesses to pool their insurance risks. C. It only offers reinsurance to other captives. D. It is required to insure only risks within Idaho. Answer B. It is formed by multiple unrelated businesses to pool their insurance risks. Explanation: a group captive is an insurance company that is formed by multiple unrelated businesses, which pool their risks and share in the underwriting profits and losses. This allows smaller businesses to access the benefits of captive insurance while spreading the risk across multiple entities. Option A is incorrect because this describes a single parent captive and not a group captive. Option C is incorrect as group captives typically provide primary insurance to their members, not just reinsurance. Option D is incorrect because group captives can insure risks both inside and outside of Idaho depending on their structure and the regulatory approval they receive. Question 28. What is the primary purpose of an actuary in the operations of a captive insurance company in Idaho? A. To provide legal advice on claims disputes. B. To assess the financial solvency of the company. C. To determine the appropriate premium rates and reserves. D. To ensure compliance with regulatory requirements. Answer C. To determine the appropriate premium rates and reserves. Explanation: an actuary plays a crucial role in a captive insurance company by assessing risk and determining appropriate premium rates and reserve levels. Actuaries use statistical models to predict future claims and help ensure that the company maintains enough funds to cover those claims. Option A is incorrect because legal advice is typically provided by attorneys, not actuaries. Option B is incorrect as assessing solvency is generally the role of the Idaho Department of Insurance, though actuaries contribute to ensuring the company has adequate reserves. Option D is incorrect because compliance is handled by regulatory experts, not actuaries. Question 29. Which of the following is true regarding the taxation of a captive insurance company in Idaho? A. Captive insurance companies in Idaho are completely exempt from state taxes. B. Captives are taxed based on their gross premiums written, not their net income. C. Captive insurance companies are taxed the same as traditional insurance companies. D. Captives in Idaho are not required to file tax returns with the state. Answer: B. Captives are taxed based on their gross premiums written, not their net income. Explanation: in Idaho, captive insurance companies are taxed on the gross premiums they write rather than on their net income. This provides a simpler method for taxation, focusing on the revenue generated from premiums rather than the profitability of the company. Option A is incorrect because captives are not fully exempt from state taxes as they are taxed on their premiums. Option C is incorrect because captives in Idaho may have different tax structures compared to traditional insurance companies. Option D is incorrect because captives are required to file tax returns like other businesses operating in Idaho. Question 30. Which of the following is a requirement for a captive insurance company to be formed in Idaho? A. The captive must have a minimum of 10 members in its group structure. B. The captive must have a parent company that is based in Idaho. C. The captive must have a minimum surplus of $250,000 to start operations. D. The captive must provide primary insurance to at least 20 different policyholders. Answer: C. The captive must have a minimum surplus of $250,000 to start operations. Explanation: to form a captive insurance company in Idaho, the company must maintain a minimum surplus of $250,000 to ensure it has sufficient financial resources to cover claims and operating costs. This requirement is part of Idaho's regulations for captives to demonstrate their financial stability. Option is incorrect because there is no minimum requirement of 10 members for captives. Group captives may have fewer or more members. Option B is incorrect because the parent company does not have to be based in Idaho. Captives can be owned by companies based outside of the state. Option D is incorrect because the captive does not have to provide primary insurance to a specific number of policyholders to be formed.